Hey, this is Andrew with Mock Till You Drop, and in this video I want to go over a topic in financial reporting and analysis called LIFO. I'm going to explain what this means, how to use a method when determining cost of goods sold, and how it affects financial statements, and also how to convert it to FIFO. So to get things going, we're going to start with this table that shows different purchase amounts and prices for ABC stock. Now, I know this isn't your traditional inventory item, but the concepts associated with LIFO will still apply here. So what exactly is LIFO? Well, it stands for last in, first out. And what that means is that when you go to sell an item of inventory, in this case shares of stock, we're going to use the latest shares as part of your cost basis. So let me show you a demonstration of what this looks like. Let's say that we want to sell 10 shares at $150 each at the end of year 4. Using the LIFO method, we're going to start with the cost basis of the latest shares purchased and work backwards. So we're going to sell all 10 shares at the $130 cost per share, which gives us a total cost of $1,300. What this also means is that there's going to be $3,300 worth of shares left in inventory at the end of year 4. And we get that by subtracting the $1,300 from the original cost basis amount of $4,600. Now there's a very important concept when using the LIFO method, and that is called the LIFO Reserve. We're going to discuss LIFO Reserve in a little more detail later in this video. But in order to determine the LIFO reserve, we need to compare 2 periods of ending inventory. Therefore, we're going to sell another 10 shares at $160 at the end of year 5. So now at the end of year 4, we already sold the 10 shares at $130 cost per share. Therefore, that has been removed from our inventory, or in this case, our cost basis. Again, we're going to start with the cost basis of the latest shares purchased and work backwards. This time, we're going to sell all 10 shares at the $120 cost per share, which gives us a total cost of $1,200. What this also means is that there's $2,100 worth of shares left in inventory at the end of the year, and we get that by subtracting the $1,200 from the $3,300. Now let's see what happens if we were to use FIFO instead, and then we're going to do a comparison between both FIFO and the LIFO methods. So we're still going to sell the 10 shares of ABC stock, but by using FIFO, we're going to start with the cost basis of the first shares purchased and work forward. So we're going to sell all 10 shares at the $100 cost per share, which gives us a total cost of $1,000 using the FIFO method. What this also means is that there's $3,600 worth of shares left in inventory at the end of year 4, and we get this by subtracting the $1,000 from the original cost basis of $4,600. At the end of year 4, we already sold the 10 shares at $100 per share. So therefore, that's been removed from our inventory, or in this case, our cost basis. Again, we're going to start with the cost basis of the first shares purchased and work forwards. This time, we're going to sell all 10 shares at the $110 cost per share, which gives us a total cost of $1,100. And this also means that there's going to be $2,500 worth of shares left in inventory at the end of the year. Again, we get this by subtracting the $1,100 from the new cost basis amount of $3,600. On the next slide, I'm going to show a comparison of the 2 methods based on the examples that we just went over and explain how financial statements can be affected by them. But before we do that, if you are a level 1 candidate in the CFA program, I highly recommend that you check out our free mock exam on our website. You can find the link below this video. And if you're looking for more mock exams, we have an entire package on our website as well. Also, if you're getting value out of this video, please smash that like button. It helps our videos out and gets more people to our videos. And also, don't forget to subscribe. Alright, so starting at the top, we're going to be selling the same amount under both methods. Although in year 5, we're selling the 10 shares at $160 per share. So when you're in an environment in which inventory prices are rising, in this case the share price was appreciating, using the FIFO method is going to give you a lower cost basis than using the LIFO method. In this case, there's a $300 difference between the two in year 4 and a $100 difference in year 5. So that's going to translate into a higher gross profit under FIFO. You might be asking yourself, why would anyone want to use the LIFO method under a rising inventory cost environment? Well, with a higher profit comes higher taxes. Therefore, using the LIFO method when inventory costs are rising can act as a tax savings. So in this case, let's assume that the investor incurs a 20% capital gains tax. They're going to pay $100 in taxes in year 4 using FIFO, but only $40 using LIFO, which is a $60 tax savings. Although in the tax savings in year 5 is a little bit less at $20. We're also going to have a lower inventory or lower ending inventory under LIFO. And what this means is that the assets under FIFO are going to be higher than they are with LIFO. And you can think about this when using ratio analysis, and that using this example, net income is going to be lower under LIFO, and the total assets under LIFO will also be lower, all else being equal. Now, on the next slide, I'm going to show you how to do a conversion from the LIFO method to the FIFO method. Now, in my last example, I used shares of stock to explain how LIFO is used, which works. But for this example, let's assume that we're using actual inventory items because shares of stocks won't exactly be the best approach. But we're still going to use all the same values from the previous slide just to keep the flow of this presentation going. And all the amounts that you see here were used in the previous slides for ending inventory. At any point during this video, feel free to go back and see how each was calculated. Now, any firm under US GAAP is required to present what is called LIFO Reserve, and that is how we're going to do our conversion from LIFO to FIFO. LIFO Reserve is simply the difference between the ending inventory under LIFO and the ending inventory under FIFO as presented here. In this example, the difference between LIFO and the FIFO methods for year 4 is $300, and for year 5 it is $400. And this is computed by subtracting the LIFO amount from the FIFO amount. Another important item from this slide is going to be the change in LIFO Reserve from the 4th to the 5th year, which is $100, simply the $400 minus the $300 LIFO reserves. This is going to be an important number in our conversion process when going from LIFO to FIFO. So here's that $100 difference that will allow us to convert from the LIFO cost of goods sold to the FIFO cost of goods sold. Now, you might be asking yourself, what if the LIFO reserves decreased from the 4th to the 5th year? In our previous example, it increased from $300 to $400, which gave us this $100 difference. But if we're not given the cost of goods sold under FIFO, how will we know whether to add or subtract this difference? Well, on the next slide, I'm going to show you a table that will help you think about this more intuitively as it pertains to the example in this video. And I think this is really going to help you determine when to add or subtract these amounts when converting from LIFO to FIFO. So if you go back to the beginning of this video, we're dealing with an increasing inventory environment, or in this case, increasing share price. What this means is that using the LIFO method, our cost of goods sold will be higher because we're taking the latest inventory cost for our calculation. Therefore, if our cost of goods sold is higher under LIFO with increasing inventory costs, we know that to compute for the FIFO cost of goods sold, we must subtract that difference. And that's exactly what we're doing in our previous slide. Now, the opposite will be true for ending inventory because we're taking the more expensive inventory items away for cost of goods sold and leaving the least expensive inventory items under LIFO. If you go back to the previous slide, you'll see that the ending inventory for FIFO is going to be lower than the ending inventory under FIFO. And the opposite will be true under a decreasing inventory environment. The last thing we're going to go over is the conversion from from LIFO to FIFO net income. Again, you want to think about this intuitively. If cost of goods sold under LIFO is higher than they are for FIFO, we can infer that the net income under FIFO is going to be higher. So let's go ahead and compute that. If you remember from the previous slides, we presented the gross profit and taxes paid. Now, assuming a simple calculation, the net income for both LIFO and FIFO for year 5 is $320 and $400 respectively, as shown here. So all we're doing is adding the change in cost of goods sold from the previous slide, since a higher cost of goods sold reduces the net income under LIFO. So we need to add that back. We're also subtracting the tax reduction since the LIFO method in this example gave us a higher tax savings. So we need to subtract that back. And this calculation is simply the $100 difference multiplied by 20% tax rate. We can also see this from our previous slide for the taxes paid under year 5. Under the LIFO method, it's exactly $20 less than it is under FIFO. All right, I hope this gave you a better understanding of the LIFO method. If you have any requests that you'd like to see for future videos, please let us know in the comment section below. Thanks for watching.